Hi everybody, this is Tim from Trading Strategy Guides. Today I'm going to show you a momentum trading strategy using the Williams %R indicator. I'll get to that shortly, but first let's cover a couple other things. First, can everybody hear me and see the title slide? Or maybe I should say, can anybody hear me? Testing. Check. Somebody let me know. Well, I guess I'm going to have to proceed here. Thank you, Mohammed Migui. Hope I pronounced those right. Appreciate that. Okay. As usual, if you're watching the recording of this live webinar, you can speed it up by clicking on the gear icon in the lower right and selecting a faster speed. Next thing, I apologize in advance, but we're having some pretty severe thunderstorms here in Northeast Texas, and heavy rain can get pretty loud in my office. So if you hear that in the background, I apologize. And of course, stay around to the end and I'll be sharing Trading Maxim number 27. Also, don't forget to click the subscribe button, then click the bell for notifications. Okay, I'm going to look at a few charts before we get into the strategy. First thing I want to look at is the Great British Pound US dollar. This given us this close below the zone that I was looking for. You know, I've been yakking about this for days. Didn't come with a huge amount of volume, but it came close to the average and it did touch the trend line. So I'm in this short for a very small piece, a quarter. It's not too late to do what I just did. So far, we're just a doji for today, which means the London session was pretty indecisive. If I'll be willing to take my loss if it closes back up in this zone again. Okay, if we see a good move down with volume, I'll add to the position. Remember, this could just be a head fake, so don't overload your trade. Okay, Tesla's earnings report is due out today after market close. So we'll see how this works out. They're expecting a loss, but still an improvement over the same quarter last year. Remember, the anticipated loss is not what moves the market. That number is already built into the price. So don't think, well, there's going to be a loss, so, you know, I'm going to go short. No, it's not time to do that. The number that deviates from the expected number is the shock that will cause the traders to move the market. So wait. Patience. The chart is, the price is right down here, bouncing off this strong support level right at the 61.8, retracement of the big move up earlier. So this is at a strong support level. Hopefully the bears will step up. Hopefully the earnings statement will be better than expected. That'll be nice. Okay, I analyzed Halliburton on Monday with my lousy dad joke. Yesterday was just a sideways day. Small, insignificant, but it did small and insignificant on really big volume. So I don't know. I don't think anybody knows what to do with Halliburton right now. Keep an eye on it though. Looking for a close above or below this triangle right here. Make sure that it's supported by volume before you do anything with it. If the volume is near the average, you might go in with a smaller size. But if you get a big volume push like these two, then you know, you can you can probably think of it in larger size chunks. Bitcoin. So Bitcoin's moving up. You know, another run up yesterday on good volume. So it looks like we're not going to get the pullback I was hoping for. The pullback to the 38.2 and the move on suggests that this is a pretty strong move up. We got to pull back. This might be a good spot to take a small chunk of this. Still, this can't. I don't know. This was just a huge move, and in my heart of hearts, I think there's more consolidation due. But I could be totally wrong. So it couldn't hurt to have a tiny piece now. If we get another close back into this consolidation area, then I would take the loss on it. Okay, Ripple. We talked about Ripple the other day. Someone commented on my Ripple video that I could find more historical data from the Binance data feed. So voila, here it is. We got lots. It goes back to October of 2017. So I can do a much better analysis than I did. So look for this video in the future. And thanks to the listener that passed that information on to me. Boeing's earnings are due before market open this morning. As far as I can tell, it hasn't been released yet. You know, we'll just have to wait on that. But right now, you know, it looks like there's been a lot of motion today. I guess this is the pre-market. It's making this descending triangle, but I think when the earnings come out, we'll know a little bit more. They're still suffering from this 737 MAX aircraft fiasco. A good friend of mine told me that that issue is fairly well known amongst most pilots, but that it could be a very bewildering situation during takeoff for a pilot that's unaware of the problem that they have. So that's the reason why there haven't been more problems with the 737 MAX. And of course, it's grounded now, so I think they're still working on the problem. Boeing, you know, this is Boeing. They're going to be around a long time, so but we may see more downside before upside. But like I say, this is a descending triangle. So the news could shake this up, but from a purely technical point of view, this looks like a short on a close below this level right here with volume support. Always look for the volume support. Okay. Let's go on and talk about the Williams %R indicator. First of all, the Williams %R is an oscillator. And let me start by saving some time here, saving someone some time anyway. Yes, these are indicators. Yes, indicators are lagging. Yes, everything we look at, including candles, is lagging. It's all historical data, unless you have one of those new crystal ball indicators or something. No, I'm just kidding. There's no such thing as that. But invariably, someone has to write a comment that says that indicators are lagging. You're right. Save your time. Don't tell us all that. We know that. Okay. If you don't like indicators, that's okay. Don't use them. You know, one of my whole points about trading and trading training is that you've got to do you. Whatever works best for you is best. That's why there are so many different strategies. Okay. So now that that's out of the way, let's talk about the %R indicator. This is an indicator, an oscillator similar to the stochastic, and it ranges from 0 to -100. I'm going to show you how to add it. This thing is a built-in indicator on most trading platforms. This is TradingView. I like TradingView. I use it a lot. I like MT4. I use it a lot. For now, I'm just going to go to indicators, select built-ins, scroll all the way to the bottom, and you'll find Williams %R right there. That's the one. Click on that. Now, I also like to add the ATR for my trade, my price risk management tool. So I do that, and I scrunch that down because I don't need the thing to be too big. But I also look at that to get an idea of what the volatility is of a instrument too. Okay. I'm going to call this the %R because Williams %R is just too hard to say. And plus it shows as %R right here. So the default is overbought -20 and oversold -80. For the purposes of this strategy, we want to change this. So to do that, you click on this gear right here that says settings, and you change the upper band to -10, the lower band to -90. Okay, so we're looking for a little bit more extreme settings than the default. The other thing we do is we will want to add a line, horizontal line at 50. So stick that in there and set it to -50, like so. Okay. All right. As you know, I prefer to trade with the trend. This strategy is designed to find momentum moves as early as possible and ride them. So the strategy rules are fairly simple. First, look for an overbought or oversold condition. That'll be less than -10 for overbought, and less and greater than -90 for oversold. Or up at the very top of the indicator for overbought, and up at the and down the very bottom for oversold. Okay. Next is to wait for a candle close where the %R signal line crosses the -50 line. That's the line that we just added. I'm going to show you these things on a chart so that you'll understand. But I just wanted to get these rules out there. After you get across the candle close and the signal line crosses the 50 line, then you trade in the direction of the price move. That's all there is to it. Okay, so back to the charts. What we're looking for is an overbought condition like this. Price is above this -10 band, or an oversold condition. Price is below the -90 band. All right. After you see that, you want to see price move across the 50 line. So here's an oversold condition. The indicator moves up and it crosses the 50. The point we're looking for is the close candle right after that line cross. Okay, you see the prior had not closed, the prior close had not crossed yet, but this one has. All right, I like to zoom into that so you can see what I'm talking about. Okay, so our entry is going to be long because price is moving from oversold up across the line. So we're going to go long right at the close of this candle. This is a bullish candle, so the close is the top of the body. I'm going to turn this line blue. Okay. That's our entry right there on this candle. So at the close of this candle, we got the cross, we go long. It's as simple as that. Now, I'm going to talk more about money management and stop losses and take profits in just a minute. I just wanted you to see what this looks like. Here's another one. We've got the prices up in the overbought above the -10. Price moves, or the indicator moves down, crosses the 50 right here. So the cross appears to have happened on this candle. Sometimes it's hard to see when you're doing this live. It's a lot easier to see whether it's crossed or not. But when you're looking at it historically, it's a little harder to see. Yes, we got this line past the cross. So this is our close right here. And in this case, we will be going short on the close of this candle. So we'll be short from about this level right here. Not quite. Yeah, my lines are a little wacky. Okay, so we're going to be short from about that level right there. Okay, it's as simple as that. So let me show you some that I picked out and worked out the details. Any of you who have listened to my strategy videos or webinars in the past, you know that I like to use the ATR for targeting and for stop loss. The ATR is the average true range, and basically what that tells you is the average of the last 14 bars, because I use 14, gives you the average length of the last 14 bars. So now this is a 15-minute chart. This strategy works well on any time frame, just about any trading instrument. But in this case, the 15-minute ATR is only 4 pips. 4 pips is way not enough for a stop loss. I don't like to see less than a 10 pip stop loss. So now if you're trading really fast 1-minute charts or something like that, you may use a smaller stop loss, but that's, you just have to work that out, see how that works for you. I prefer not to see less than a 10 pip stop loss. If you try to use too small a stop loss, you're shooting yourself in the foot, in my opinion. Okay. So the ATR is 4 pips, but I'm going to use a 10 pip stop loss and a 10 pip target on this trade. So the 10 pip stop loss would be down here, the 10 pip target up here. I use a position size calculator to determine the size of my position that would risk only 2% of my account if this trade hits the stop loss. So the position size calculator I use is at myfxbook.com. I'll put a link below the video when we get done here for you. It's a great position size calculator. It lets you enter the size of your account, the percent risk that you're willing to risk, the size of your stop in pips, and then it tells you the size of your trade so that if you hit that stop, it will only risk that percentage of your account. I recommend that you keep your percentage small. I use 2% in most cases. I will size down in a less if my trade is not as sure as I would like it to be, like for instance, when I was talking about some of these trades, like the pound dollar, where we don't have the volume support that I like, I went in with a quarter size position here. So I have my stop in this zone up here, and I calculated a 0.5% risk on this trade. Okay, so I use a 2% position though when I'm using a specific strategy like this, and of course all the rules have to be met. And when I use the 2% position. So the way I do this, you can work out what works best for you, but I will calculate the 2%, then I'll divide that position size in half and enter 2 positions long simultaneous positions, each half size, each with a 10 pip stop and one of them with a 10 pip target. Okay. If it hits the stop, it takes both positions out and I take my 2% loss. If it hits the target, it will close one position for profit. At that point, I will move my stop loss up here to break even or maybe a pip above, and I will let the second position run until it either hits the stop or until it starts looking like, it's going to push hard down. So this one, I most likely would have ended up taking the stop when it pushed down here because it did not really push up too much further past this target. But there are other times when I might have gotten a significant amount by doing this, and I'll show you that in just a minute. Think of the first position as covering your losses. Okay, I know you're taking a 2% loss and you're only collecting 6.67% win here, but you're going to get significantly more wins than you are losses, and that will compensate. These little wins right here will compensate for your losses, and then you will profit on your big moves. Okay, so let's take a look at this pound yen chart. I looked at this trade right here. See, it went down to oversold, came up and crossed the 50 right here. On that close, this is a daily chart. So the ATR was 174. So my stop loss is 261 pips here. My take profit is 174 pips. So this hit my stop loss, so I closed it. One position, I moved the stop loss to break even, and this thing just kept pushing on up. So this trade would probably still be open, unless on this push up I had pulled my stop up too much, and I've been known to do that sometimes. It's okay. These things happen. Here is another signal, but a short signal, and this probably would have been a loser, except that I probably am still in this trade. So might have missed that altogether. But this right here is an example of what I was saying earlier. If you took this, it was in the oversold, overbought condition here, came down, crossed the 50 right here. This is the very next candle. If we traded this close, the ATR was 166 right here. So our initial target would be right in here. So we most likely would have taken first profit here, moved our stop to break even, and if I had managed the stops properly, this went 1,370 pips down to here. So I don't know if well, this is a daily chart, so I'm sure I would have seen this. I look at the charts at least once a day. I'm sure that I would have seen this right here. So I would have been out of this. At the very least, I probably would have been out of it on this candle right here. So anyway, that's, potentially over $1,000 trade, 1,000 pip trade right there. That is where you make your profit. The ones that come back and hit your break-even stop loss, those are just covering your losses, keeping you solvent until you can make moves like this. Okay. I want you guys to remember these examples are cherry picked. That's another thing that, people are, oh, you cherry picked. Well, of course I cherry picked my examples. You got to see how the trade works and what it's supposed to do. They don't all win like this right here. If you missed this one and got in this one right here, this didn't push down enough to hit the target. So yeah, this one probably would have popped up and you would have taken a loss. But I'm also all about having um, exit strategies, exit indicators that get me out without taking full losses too. But that's a story for another day. Okay. You know, the whole point here is in real life, these are not going to win every time. So though I don't want you to think that you did anything wrong if it does lose. And the reason I say that, for those of you who haven't heard me preach about this, that was my problem in the beginning when I started trading in '04. I dabbled a little bit in the 80s and the 90s, but in 2004 I started trading in earnest and trying to learn and be a good trader. And for a year or so, I lost a lot of money because I thought I was doing something wrong when I took a loss. So I would go back to paper trade and I would win when I paper traded. And then when I started taking trades in my live account, I would lose. And I thought, well, I'm doing something wrong. I'm going back to paper trading. Look, part of the job is taking losses. Okay. Okay. The whole idea of being a successful trader is knowing that no one knows what the market is going to do from minute to minute or day to day. So we find statistical edges for our entries and we use money management to be profitable. I know proper money management is boring as all get out, but it's the key to being successful. So money management and trade psychology, understanding that there are going to be losses. You can't get your feel bads hurt if you take a loss. I've heard, in trading rooms, everybody goes, oh, I'm so sorry you took this loss. No, I hate to be hard nosed about this, but I'm kind of the tough love guy. You took a loss. Well, that's too bad, but move on. Okay. All right. That's all I have on this strategy. Does anybody have any questions, comments? I don't want to hear opposing viewpoints. No, actually, I don't mind opposing viewpoints. Is everybody good? Hi, everybody. Tomas Abor. I hope I'm not butchering your names. Lothar, Keith. I'm pretty sure I know how to pronounce that one. Dimfo, Ozzy. No questions. Anything on strategy, money management? Cool. All right. Well, that's great. If you guys have any questions, don't hesitate to post them below the video. This video, I'm not sure exactly how long it takes to get posted, but you'll be able to watch it and so on. If you have any questions about anything, I'd be happy to answer them. Okay, you made it to the maxim. Today's number 27. Profitable trading requires patience. So why am I not patient? You need a large measure of patience to be a successful trader. You can't just, jump in willy-nilly when it looks like it's going a certain way. You have to be patient and wait for the trade to come to you. And you know what? I hate it when people say, wait for the trade to come to you. It just, but it's accurate. So maybe that's the reason why I hate it. What it means is wait for all of your rules to be met before you enter the trade. Don't just enter because it's close. Doughboy, that's a really good question. My risk is more than my reward initially, but I anticipate having a greater than 50% win ratio. Okay, so you don't always have to have your risk less than your reward. And what you're going to find out is the trade-off is if your risk is smaller than your reward, your win ratio is going to drop. Conversely, if your reward is greater than, if your risk is greater than your reward, your win ratio is likely to increase. So that's the trade-off. I can be a winner with a 50% win ratio. In other words, I win half of my trades if my reward is greater than my risk. So if every win is going to win me more money than every loss does, then I can win with a 50% win ratio. But if you have a strategy that has a higher win ratio, say 70%, even 60%, then it's not as important for your reward to be greater than your risk. Okay. What you have to do is look at your profit at the end of the day. And in this case, in most cases, let me go back to this example to try to demonstrate it better. Okay, I'm going to move this back. I don't know exactly where this was, but it was 261 pip loss. Okay, now if this thing goes all the way down to a 261 pip loss, then I've lost 2% of my account. If this thing pops to my target here, then I've made 0.67% because my target is 2/3 of my stop loss. Okay, so and my second half is break even. If I have a win ratio of about 70% using this strategy, then I'm going to be break even. The profitable part of this trade are the big moves like this. Okay, so this one, the first piece is out, so I have half of my trade running for however many I got on this, 1,000 pips. It's probable that I did not get out down here. So maybe I got here for 800 pips or something. Okay. So that's where the actual profit in your trading comes from. Catching these big moves right here. Okay. And that's the reason why, your risk to reward, a lot of trainers stress risk to reward. It's got to be 2-to-1, 2-to-1 reward to risk, or better. But that's if you're looking at a strategy with a win rate of 40%. But if you've got a good strategy that has a higher win rate, then the risk to reward is less important. Plus, the other thing that I do, and like I say, this will be a discussion for another day. But another one I like to do is have an indicator, an exit indicator. And the exit indicator is what tells you early on that the market has turned. And if you have that exit indicator, then if price is pushing down toward your stop loss, it will give you a signal to get out before you actually take a full loss. Okay. Average winner, average loser. I recommend that you backtest this and get those numbers for yourself. Okay, because there are so many details to this trade that you are likely to get different results than I do to any trading, to any strategy. Okay. backtest. And if you backtest, then you're going to understand how the strategy works internally. You're going to understand in yourself how this strategy works. I hate to sound, uber philosophical there, but that's, so much trading is mental, and you really have to have an innate understanding of what strategies you use. The strategies I trade on the regular, I understand intimately how they work. And if they stop working for some reason, I most likely understand why and can make adjustments for it. So, Tomas, there's a setting on that strategy. I'm not sure I understand your question. Does anybody else have any questions? So I just want to stress the maxim just a little bit more: patience, patience, patience. If you've got a good strategy that you back tested and you have confidence, and you forward tested it and you have confidence in the strategy, then wait for it. Don't get the FOMO, FOMO, fear of missing out. If you missed the entry, you missed it. Just move on. There's lots more. Ozzy, absolutely. The trend be with you. The trend be with you. Yes, Keith, thanks. You click the gear right there. Bam. The upper band is -10. The lower band is -90. And the line is -50. Okay, right in the center. Thanks, Keith. I hope that answers your question, Tomas. Okay. I appreciate it, you guys. I appreciate you listening. Thanks for subscribing. And if this webinar has helped you, please hit the thumbs up below. All right. Have a great week, and I will see you the next time we do this. Hopefully next Wednesday. Have a great day.